You are 31 years old. You have 61,000 in a savings account and a logistics job at a regional trucking company that pays 58,000 a year. On a Sunday in October, you drive down State Route 9, 4 miles past a town of 9,000 people, and you see it. 44 metal storage units behind a sagging chain-link fence. Half the doors streaked with rust, a plywood sign that says Steepen, and a phone number missing a digit. You find the owner anyway. His name is Dale. He is 71. He built the lot in 1994, and he keeps every record it has ever produced in a spiral notebook held shut with a rubber band. He wants $185,000. He will carry the financing himself, $37,000 down, the balance at 7% over 10 years, because he already knows what you learn at the bank that Tuesday. The loan officer does not say no to a $185,000 storage deal. He says he'll call you. He does not call you. Banks don't bother at this size. Dale does. So you sit at Dale's kitchen table and read the notebook. 44 units, a mix of 5 bicheck dents and 10 dex-10s. 27 are occupied. That is 61%. The average tenant pays $68 a month against a county market rate of $100 and up, because Dale has not raised rent since 2016 and knows every tenant's first name and most of their mothers. Gross income runs about $1,850 a month. Expenses are gravel cheap, property taxes, a liability policy, a mower. Net operating income, roughly $18,000 a year. You are paying $185,000 for $18,000 of annual income. Divide the second number by the first and you get 9.7%. Call it a 10 cap in the language you are about to spend the rest of your life speaking. Prices this good exist only on properties nobody is bidding on. Nobody was bidding. You close in November at Dale's kitchen table, with a title company an hour away and a handshake that lasts slightly too long. Then the unglamorous part. You cut 6 padlocks off 6 abandoned units with a 34 bolt cutter and run the contents through a lean auction that nets $1,140 and one working chest freezer. You replace the gate chain. You fix the pole light, dark, since 2021. You paint a sign by hand, whiteboard, black numbers, 10 x 10, 95. You put the lot on Google Maps yourself on a Thursday night from your couch. Then you raise rents, not all at once, 68 to 79, then 79 to 89, letters mailed 60 days apart across 14 months. 4 tenants leave, 11 arrive, because the lot now appears when anyone within 20 miles types storage near me into a phone. Occupancy climbs to 84%. You spend your Saturdays out there with a weed trimmer and a clipboard, and you learn the 2 numbers that run this entire business, what a door earns when it is rented, and what it costs you when it is not. 2 years in, the lot reads like a different property. NOI is $34,000. An appraiser named Ted walks the gravel for 20 minutes, counts doors, photographs the gate, and values it at an 8 cap, $425,000. Dale's note has $127,000 left on it. You put in $37,000 in 2 years of Saturdays, and your equity is now roughly $298,000. 8 times your money, and not 1 hour of it felt like investing. It felt like mowing, you understand, finally, what you actually purchased on that Sunday in October. You did not buy real estate. You bought neglect, and you fixed it. Somewhere out on another state route, there is more of it. There is always more of it. Level 2 begins in the parking lot of a 240-unit facility in a county seat town of 23,000, 40 minutes east on the same state route. The owners are Ed and Lorraine, married 44 years, and they run the place the way Dale ran his: paper ledgers, no website, an answering machine that fills up by Saturday noon. The asking price is $875,000. The net operating income is $65,000 a year. That is a 7.4 cap, and this time you are not the only person alive who can do the division. You are just the only one standing in the parking lot. You cannot write a check for $875,000. You can write a check for 10% of it, and the federal government will guarantee most of the rest. The instrument is an SBA 7 loan, and the gatekeeper is a banker named Priya at a community bank 2 counties over, who has closed 41 of these and declined more than she has closed. The terms: 10% down for a first-time facility buyer who can show operating history. Your 2 years on Route 9 are the ticket in 25-year amortization, interest at prime plus 2.75. Priya cares about exactly one ratio, and she says it before hello: debt service coverage of 1.25. The building's income has to cover the loan payment 1.25 times, with room left over for the year the roof leaks. Ed and Lorraine's $65,000 clears the bar. Barely, which is how these deals are supposed to clear it. The down payment comes out of Dale's lot. A local bank refinances it against the $425,000 appraisal at 70%, $297,000. You retire Dale's remaining $127,000 and walk away with roughly $158,000 in cash you never had to save. This is the first structural lesson of level 2. Equity you create is equity you can borrow. The lot keeps mowing along, quietly servicing its new mortgage, and its value just bought a building 9 times its size. You close in March. Then you do the thing that is worth more than the building. You put up a website with online reservations, so a divorce at 11 p.m. becomes a move-in at 9 a.m. You post 2 prices for the same 10 by 10, 1.50 per square foot on the street sign, 1.24 online. The web price is the real price, the sign is for people who don't compare. You switch 240 tenants to autopay, and delinquency falls from 11% to 4%. You add tenant insurance at $12 a month, of which roughly half is margin. You add a $25 admin fee at move-in. You run lean auctions on day 60, every time, on schedule, without anger and without exceptions. Ed used to let people slide until Christmas. You are not running a charity. Here is the whole thesis, and it fits in one sentence. Unsophisticated operators run 70.8% occupancy nationally, and the REITs run 84.5%. Same metal boxes, same climate, same divorces, downsizings, and deaths filling the units. The 14-point gap is not location. It is software, pricing, and follow-through, and it is lying on the ground in every small market in America, waiting for someone willing to pick it up. 18 months in, revenue is up 38% with the same walls and the same doors. NOI goes from $65,000 to $103,000. A commercial appraiser, a real one this time, with a 34-page report, applies a 6.75 cap to a professionally managed facility with documented income, and the building is worth $1.53 million. You paid $875,000. You created roughly $650,000 of value with a website, a fee schedule, and the discipline to mail letters on time. Lorraine sends a card at Christmas. She says the place looks the same. From the road, it does. Then Priya tells you the rule nobody mentions at level 1. Now that you operate a profitable facility, the SBA treats buying a competitor in your market as an expansion of an existing business, financeable at or near 100%. You ask her to repeat it. She does, in the same flat voice. The down payment problem disappears at the exact moment you no longer need it to. This is how the ladder works. Every rung is easiest to reach from the rung below it and invisible from the ground. Level 3 is 2 purchases in 18 months. Facility 2, $1.1 million, 210 units, Class C, in a town whose biggest employer is a hospital, bought at a 7.3 cap from a man who inherited it and resents it. Facility 3, $1.4 million, 260 units, a 7.1 cap, bought from an estate. The late owner's daughters live in Phoenix and want a wire transfer, not a storage business. Both deals close with almost none of your own cash, because the government now considers you a proven operator and Priya considers you a repeat customer. Add them up. 3 facilities appraising at just over $4 million. Debt against them, about $2.9 million. Equity, the part that is actually yours, roughly $1.1 million. 5 years ago, it was $61,000 and a pickup truck. You cannot stand in 3 parking lots at once, so you hire Renata. She ran the front desk of a Best Western for 9 years, which means she has already survived every kind of customer a storage facility can produce. She drives 380 miles a week in a Corolla with a magnetic sign on the door, move-ins, lock checks, the occasional stern conversation. Behind her, the buildings run themselves, a kiosk at Facility 2 that rents units at 2 a.m., cameras you check from your phone, smart locks, gate codes issued by software the moment a card clears. 1 payroll, spread across 3 properties instead of drowning one. Your operating expense ratio drops from 41% of revenue to 33%, and every point of that lands directly in NOI, and at these cap rates, every recurring dollar of NOI is worth about $15 a building. A lawyer in the county seat charges you $1,400 to draw the structure and $800 in filing fees to stand it up, 1 LLC per property, and above them a management company that charges each building 6% of gross for the privilege of being run properly. No course teaches this. Every operator who survives converges on it anyway. If a tenant sues Facility 2, Facilities 1 and 3 do not exist to them. And the management company, the one entity that owns no real estate at all, is where the actual business now lives. The software, the pricing, Renata, the playbook. Then the last gear engages. The county seat facility stabilizes at 84% occupancy, and you refinance it against the $1.53 million appraisal. The new loan retires the SBA note and puts $280,000 of cash in your account, not income, loan proceeds, untaxed, a fact that never stops feeling like a misprint. That $280,000 is the down payment on whatever comes next. And now you can see the whole machine at once, the flywheel every storage operator eventually finds. Buy neglect at a 7.5 cap, operate it to 84% occupancy, refinance at 6.5, and feed the proceeds back into the front of the machine. Repeat, you are 36. On Saturdays, you still drive Route 9, past Dale's 44 doors, and the notebook with the rubber band sits in your desk drawer like a fossil. The flywheel is turning. The only thing it asks for now is more deals than your own signature can carry, but that is next year's problem, and you have gotten very good at next year's problems. Next year's problem arrives 11 months later, and it looks like this. A fourth facility, 320 units in a town you already know, priced at $2.1 million, and a bank that has finally found the edge of your signature. Priya lays it out without apology. 3 loans, a refinance, and your name under every dollar of the debt. The ratios that used to open doors have become the doors. You can wait 2 years and buy the building out of retained cash flow, or you can learn the sentence that separates level 3 from level 4. It does not have to be your money. A securities attorney named Marcus Feld charges you $28,000 to draft 90 pages that nobody will read and everybody needs. Regulation D, Rule 506B, no advertising, no strangers, only people you already know, which turns out to be the entire point. You make a list, your dentist, Renata's brother-in-law, who owns 4 car washes and distrusts the stock market on principle, a retired anesthesiologist who rents unit 114 at the county seat facility and asked you once at the gate what exactly you did. 22 names. You raised $3.2 million in 9 weeks, in checks from $50,000 to $400,000 across kitchen tables and diner booths, and you pay for every coffee. The structure is standard, and you learn why it is standard. Your investors receive an 8% preferred return before you receive anything. Their money eats first. Above the profits split 70-30, 70 to them, 30 to you. You take a 2% acquisition fee at closing for finding the deal and carrying it there. And the management company, the 801, charges its usual 6% of gross to run whatever the syndicate buys. Count the streams: a fee for buying, a fee for operating, a share of the upside, and a return on your own cash invested beside theirs. 4 different ways to be paid by the same metal boxes. This is what the lawyer's 90 pages actually purchase. Then comes the deal that justifies the machinery. Gene is 68 and built 6 facilities across 2 counties over 31 years, 1 slab at a time. His sons are a radiologist in Denver and a Marine at Camp Pendleton, and neither of them wants gravel. He asks $9.8 million for the package and cries once, briefly, at the closing table and shakes your hand hard enough to mean something. 6 properties, 1,340 units, a blended 7.4 cap on day 1, and every page of the professionalization playbook still unrun. Fold it all together and the portfolio crosses $20 million, 11 facilities, roughly 2,400 doors. You are 38, and here you learn the arbitrage that sits above the operational one. A single Class C building in a tertiary town trades at a 7.25 cap because the only bidders are local and tired. 11 stabilized facilities under 1 brand, 1 management company, 1 clean audited financial package that trades in the low 6s to buyers with more money than time. Same walls, same doors, worth 15% more for being assembled. You are no longer just fixing neglect. The assembling is itself the product, and you are the only one in 3 counties doing it on purpose. The job has changed underneath you quietly, the way jobs do. You underwrite 40 deals to buy 2, and the folder of dead deals is thicker than the folder of owned ones. Tuesdays are investor calls now. The anesthesiologist likes detail, the car wash brother-in-law likes brevity, and you have learned to give each man his preferred sentence. You have not personally cut a padlock in 3 years. The bolt cutters hang on a nail in your garage, and some Saturday mornings, driving Route 9 past Dale's 44 doors, you catch yourself missing the specific sound they made, the small clean snap of a problem you could solve with your hands. You do not miss it, is what you tell people. The fund's bank account tells a different story about what you traded, and pays for it monthly, and the payment's clear. Level 5 begins with an audit you asked for. Raising money deal by deal means 22 phone calls every time a building surfaces, and buildings do not wait for phone calls. So at 41 you raise Fund 2, $25 million, discretionary, meaning the investors commit first and you decide what it buys. Most of it comes in familiar checks. Then a family office out of Charlotte, the money from 3 generations of plumbing fixtures, sends a man named Walter Brand to spend 2 days in your office reading lease files. Walter wears the same gray sweater both days and asks 1 question per hour, each one better than the last. He commits $10 million, and the price of it is written in the side letter: audited annual statements, quarterly reports with footnotes, and a real chief financial officer, not a bookkeeper with a nicer title. You hire Diane, 19 years at a regional grocery chain, who looks at your books for a week and says storage is the most relaxing thing she has ever seen. Priya's bank, meanwhile, has a legal lending limit of $4.2 million, and you have outgrown it the way children outgrow shoes. She refers you upward herself, which is its own kind of graduation. Your debt is now a relationship with a life insurance company in Des Moines that thinks in decades and has never once called your cell phone. The fund buys steadily, and by 43 you operate 31 facilities. That number forces the next change, a name. You pay a branding firm $18,000 and they hand back a word, a font, and a shade of blue, and now every gate in 4 states says Copperline Storage. Behind the gates, the company has organs. 8 people in one office answer every call for all 31 properties. Renata runs operations now. The Corolla is long gone. She manages 9 traveling managers and interviews like she is guarding a gate, which she is. And a revenue management system prices the units the way an airline prices seats. The software raises a 10 by 6 on a Friday when the building runs hot, trims 4 on a Tuesday when move-ins stall, and executes 10,000 of these decisions a year without asking anyone. Then you build one from dirt, because at this size you finally can. 9 acres on a commercial corridor for $600,000. A single-story facility, 62,000 square feet, at 68 a foot hard cost, call it $6.1 million all in once soft costs, interest, and the parking lot are counted. It opens empty, which is a feeling no acquisition ever gave you, 480 brand new doors and not one tenant. Lease up takes 30 months and every one of them costs money. But at stabilization the building throws off $560,000 of NOI on your $6.1 million, a 9% yield on cost, and the market values stabilized storage near a 6 cap, which prices the building around $9.3 million. Build to a 9, own at a 6. $3 million conjured from a cornfield over 30 patient months. The market takes its tuition back the same year. Street rates soften roughly 10% industry-wide, and in 2 of your submarkets, developers who ran your same cornfield math all reach the same cornfield at once. 3 new facilities opened within 2 miles of your Milton Road property. You run the entire playbook: web pricing, autopay, fee income, auctions, and the building sits at 71% occupancy anyway, exactly the number the unsophisticated operators run, and stays there. You cut street rates 14% and it holds barely. This is the expensive lesson of level 5, and it costs you about $400,000 a year in NOI that should exist and does not. The playbook fixes neglect, and neglect was never the only variable. Supply is the one enemy the playbook cannot touch. You start paying for demographic studies before you buy dirt. Walter, on the quarterly call, says only that he has seen this movie in plumbing fixtures. The tape at 43 reads like this: roughly $80 million in gross asset value, about $34 million of it equity across the funds, 31 facilities, 1 brand, 1 lesson scarred in. The machine still turns. It just knows its own weather now. At 46, the phone call you always knew was coming finally comes. A REIT's acquisitions team flies in, 2 analysts and a vice president named Grant who wears a fleece vest with the fund's logo and calls your facility's assets the way other people say chairs. They spend 4 days in your data room and come back with a number built on a 5.6 cap. Buildings you assembled at 7s at 7 1/4, at Gene's blended 7.4 repriced in one spreadsheet because they are stabilized, branded, audited, and boring in exactly the way institutions pay premiums for. The whole arbitrage of your adult life, paying out in a single wire. Grant slides the letter of intent across the table, and the number on it is $250 million. You do not take the wire. Not out of sentiment, out of arithmetic, and a lawyer named Avi Stern, who bills $1,240 an hour and is the first person you have ever met who gets visibly happy reading an org chart. The wire is a taxable event the size of a county budget, and it buys you out of a machine that is still accelerating. So Avi builds the alternative, a recapitalization. A private equity partner, a woman named Dana Okafor, whose Chicago fund has been circling storage for 2 years, buys 49% of the company at that same $250 million enterprise valuation. The early money exits at 2.1 times. The retired anesthesiologist from Unit 114, who wired $200,000 across a diner booth 9 years ago, receives $420,000 and sends you a bottle of scotch with no note, which you understand completely. Walter's family office rolls forward. You keep 51%, the chairman's seat, and control. The empire is worth $250 million, and it is still yours to steer. What Dana actually bought deserves one clear look, because it is the shape of the whole game. The HoldCo sits on top. Under it, a PropCo owns the real estate, 54 facilities, 11,000 doors of it. Beside that, an OPCo owns everything that is not real estate, the Copperline brand, the call center, the revenue software, the tenant insurance program with its patient 50% margin, Renata and her 9 managers, Diane and her footnotes. And a DevCo turns dirt into buildings, 2 ground-ups a year, each one built to a 9 and owned at a 6. Here is the part nobody sees coming at level 3. That OpCo is the management company you formed for 800 in filing fees, the one the lawyer in the county seat stood up in an afternoon. Real estate trades at cap rates. Operating companies trade at multiples of earnings. Dana's fund valued the OPCO at 11 times its cash flow. The single most valuable thing you own is the one that owns no property at all. Your personal tape, after the recap, roughly $61 million of net equity and distributions of about $3.4 million a year that arrive whether you get out of bed or not. And one number that matters more than either. For the first time since the afternoon Dale slid a spiral notebook across his kitchen table. Your personal guarantee count is 0. The Des Moines lender lends to the PropCo now. If everything burns down, they take the buildings and not the house. You notice a missing signature line on the new loan documents the way you notice a tooth that has stopped aching by its absence at odd moments gratefully. And here's the part that still makes you laugh, quietly in parking lots. The $250 million enterprise is 54 gravel lots full of metal boxes on the edges of towns most people drive through without slowing down. There is no lobby. There is no logo on a skyline. At dinner parties, someone asks what you do, and you say self-storage, and they say, "Oh, interesting," and turn to the person on their other side, and in 20 years nobody has ever asked a second question. You have stopped minding. You may have started counting on it. The loudest asset classes hold conferences in Las Vegas. Yours holds auctions on gravel on Tuesdays and compounds either way. Run the ledger backward once, from the top, and look at what each level actually required. Level 6 required a lawyer who understood recapitalizations and the nerve to decline $250 million in one wire. Level 5 required a man in a gray sweater and his family's $10 million and the audited statements that were the price of his signature. Level 4 required 22 people who knew your face well enough to trust you across a diner booth. Level 3 required a manager you could hand 3 parking lots to and an 800 company nobody told you to form. Level 2 required 1 community banker's confidence and 10% down. And Level 1 required $37,000, a pair of bolt cutters, and a tolerance for padlocks. That is the whole ladder. Not one rung required genius. Each one required only the rung below it, and here is the part worth carrying out of this video in your back pocket. Every level was fully available to the person standing one level beneath it, and completely invisible to everyone else. Dale could not see the SBA loan. The man at level 2 could not yet see the syndicate. Walter's $10 million was unimaginable across a diner booth and obvious from 31 facilities. The ladder never hid. It just only shows you one rung at a time, and only from directly below. Dale's 44 doors still sit on Route 9 outside a town of 9,000. The gravel is graded now, the gate opens off an app, and the hand-painted price sign is gone. The lot wears a blue copper line sign, the smallest one the vendor makes. It is the least significant asset in a 54-property PropCo, and it stays in the portfolio anyway, and nobody at the fund has ever asked why, and you have never offered. The spiral notebook is still in the desk drawer, rubber band gone brittle. NOI on the lot last year, 41,000. Dale would have circled it in pencil. The Tuesday after the recap wire cleared, the call center opened at 8:00, the software trimmed at 10 packs 10 in Ohio by $4, and 3 lien auctions ran on schedule. The Tuesday still came, it always does. The doors don't know what they're worth. They just compound, in silence, one padlock at a time.